Welcome to ODEON Capital Conversations on all things money and markets with Dick Bove and Matt Van Alstyne. And here is your host, John Aidan Byrne.
On this episode, Dick Bove will present his evidence of what is driving US interest rates, with the 10-year Treasury yield having hit a new 16-year high. Dick breaks it all down, starting with the sharp reduction in the US money supply. We'll look at the views of Harvard professor Jason Furman, who contends losses at the US Federal Reserve today don't matter, while another commentator says the Fed's losses are in effect losses to the US taxpayer. Matt Van Alstyne will share his views on interest rates, inflation, and the US banking system. We'll discuss the Taylor Swift phenomena on spending and consumer behaviour. We'll discuss housing, with existing home prices up in most of the US metro areas in the second quarter. And Dick will offer his thoughts on a book by a French writer which sheds light on the Green New Deal debate today. I'm with Dick Bove, Chief Financial Strategist at ODEON Capital Group, and Matt Van Alstyne, ODEON co-founder and managing partner. And we'll be right back after this message.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.
You're listening to episode 89 of ODEON Capital Conversations. I'm here with Dick Bove and Matt Van Alstyne. Dick, I got to address you with this, the money supply, interest rates, and I'm starting to get a little more alarmed about this whole situation, and maybe you can kind of guide us and direct us. Two interesting pieces recently on the money supply in the Fed balance sheet. Professor Jason Furman at Harvard was chairman of the White House Council of Economic Advisors under President Obama, and in a recent op-ed contends that profits and losses don't matter at the Federal Reserve. He also said insolvency is a meaningless concept for a central bank. He even said some central banks have operated just fine with negative capital. There is no economic or accounting constraint on the Fed. He says its profits can rise by $1 trillion, fall by $1 trillion, but it does not matter, Professor Furman says. I mean, I was left breathless having listened to your analysis over the past year or two of this fine podcast. And meanwhile, an article in The Hill by J Pollack takes the opposite tact. And he said there has just been a landmark event at the Federal Reserve. Its accumulated operating losses have passed 100 billion. And he goes on to say this startling number, which would previously been thought impossible, was reported on September 2023. He goes on to say these are equally losses to the US Treasury and thus costs to the taxpayer. Nonetheless, the Fed keeps officially insisting that its losses don't matter. And we see a lot going on there with interest rates. And you had a note out this morning headlined, "My head is going to explode." These are your words. And you had a chart there on the 10-year yield, which has hit its highest level since 2007.
Okay, well, obviously, we've been talking about this for a year. I mean, we've been talking about the Fed being insolvent. We've been talking about the Fed losing money. And we've been talking about the fact that those two factors constrain the ability of the Fed to manage monetary policy freely. All right, and essentially nobody has cared about this argument, and they have agreed with, I guess, the Harvard professor, which essentially who is essentially saying they can run whatever type of deficit they want. They can, basically lose as much money as they want. It just doesn't matter. Well, we're finding out that in fact it does matter. The two charts, unfortunately, we can't show that on a podcast, but the two charts that we put out this morning, are complementary to each other. One chart shows how the Federal Reserve during the pandemic increased the money supply of the United States, dramatically. It was up 26% year over year. At the peak. And if you add up all the money that was created, it was about $7 trillion, right? And that's a lot of money. I know that people throw money numbers around all the time, but $7 trillion is a lot of money. And the other thing that this chart shows is that when the Fed had the opportunity, it started to reverse its policy, and it's reversed its policy so dramatically that right now, year over year, the money supply of the United States is declining by 3.5%. Or if we put it in specific numbers, they printed 7 trillion, and now they've gotten rid of 1 trillion of the 7 trillion. And they've done that in a period of 18 months. Again, I would assume when the bank holiday occurred in 1933 that the same thing may have happened, but it's never happened since then. And it may never have happened before that. You can't go from printing money at an incredibly rapid rate to shrinking money and assume that there'll be no impact on interest rates. Obviously, what happens if you dry up the supply of money, you're making it more difficult for borrowers to get funds, and that drives up interest rates, which is exactly what's happening. What we show in the second chart, is if you were to take and turn the interest rate chart upside down, it would mirror the money supply chart. It would show that when money supply was growing rapidly, interest rates were falling to what turned out to be record lows. And when the Fed started shrinking the money supply, interest rates started going up. And I think, therefore, instead of all this verbiage that you hear on television and from all of these experts and all the things that they're writing, just take a look at those two simple numbers. If the money supply is going to continue to fall, people are not going to be able to borrow as much as they would like. And when they do borrow, the cost of that money is going to be substantially higher. And we've mentioned how, the mortgage rate has gone from about 3.25% to 7.5%, how the auto loan rate has gone from 4% to 8.25%, how the credit card rate has gone from 12% to 22%. Well, that's the reason. The reason is because there isn't the same supply of money available. And if you want it, you got to pay up to get it. And that, in my view, is why we're going to have a recession in 2024.
I got to jump in here. I've been confused about this argument the entire time. And I agree with Professor Furman that it doesn't matter, because my understanding of the Federal Reserve Act is that the Federal Reserve is not required to do a mark-to-market accounting. And the assertion that losses is somehow limiting their ability to affect monetary policy doesn't jive with what I think is their actual goal. And I feel like maybe I'm confused, but from what I'm reading is I feel like you're confusing the cause and the effect. I feel like they're shrinking the money supply on purpose to drive up interest rates because they want the economy to slow as a way to, in my mind, psychotically, but this was what I think they're trying to do. They're trying to shrink inflation by shrinking the economy, by causing a recession, and they're shrinking the money supply on purpose. And it's not that the power to control monetary policy has been taken away from them, is that they're using their power in this method. And I think you're exactly right. Looking at your chart, it's really hard to miss the connection between the shrinking money supply and the growing interest rates. It's clear. And as we were talking just a little bit before we got on, I just watched a video from Rick Santelli where he laid it out and talked about how this is what they did in the 1980s as well, or late 1970s. And so I feel like you're getting the cause and effect wrong. And I don't feel like they're being handcuffed in any way. I think this is the plan.
Well, I mean, it's obviously the plan, no question about that. And all we've said to this point is that if you shrink the money supply, interest rates are going to go up. But the second issue is to whether it matters whether the Federal Reserve loses money or not. That's the one, I guess, that you're contending. That's the point you're contending with. And essentially, remember, the Federal Reserve is wholly owned by the United States government. By the United States Treasury. And all of the losses that the Federal Reserve accrues are losses to the United States Treasury. So the United States Treasury, was getting a couple of years ago, it was actually getting dividends of $90 billion, a year from the Federal Reserve. They're now having to backstop the losses that the Federal Reserve is generating. So, this is not just
in reality or in theory. Like, do they actually have to cut a, cut a check?
Yeah, well, someone's got to get someone. The Fed can print the money if it chooses to cover those losses.
But isn't that the total rub? If they can print the money to cover the losses, then it's not impactful.
Well, it does. It is impactful if the losses are so great that they can't print the money.
Correct me if I'm wrong. Is there a limit to how much money the Fed can print anywhere in statute?
There's a limit in terms of reality in the world. The Fed cannot go out and print $2 trillion. If they go out and print $2 trillion, inflation is going to go up to, who knows, you pick the number. There's no statute that says that the Federal Reserve cannot lose as much money as the Federal Reserve wants, and there's no law statute which is saying the Federal Reserve, has a limit to the amount of money it creates. There is a marketplace, however, and in the marketplace they cannot create an unlimited amount of money.
So if they're not marking to market, because that's one of the topics we keep talking about, is that they have all these unrealized losses, which I think is, mathematically accurate. I don't dispute that one way or the other, but they're not realizing those losses. Is that just a form of hidden money printing by not marking their books accurately? Because
no, they're saving the money in cash. They're losing cash dollars. The yield on the Federal Reserve, assets, they've got all these fixed income mortgages, which they bought in the period when interest rates were in this 3.25%, 3.5% range, right? Or I don't care, you can say 4%. They're now borrowing money in the repo market at 5.5%. So that's a loss in real money. You're getting 3.25% in terms of the yields on your assets. You're paying out 5.25%. Take the banks, the deposits that the bank make at the Fed. The banks are now getting 5.5% on the hundreds in the trillions of dollars that they've invested in the Fed. The Fed's got to pay them 5.5% in yields from their assets.
Okay, I understand that. So prior to this reversion or inversion, they were making money and sending that money to the Treasury. The Treasury is profiting. Now they're losing money and the Treasury is no longer profiting, but the Treasury is not printing money and sending it back. What it sounds like is happening is every single day the Fed is printing $5, $10, $15 billion to cover that net loss on their cost of capital versus what they're paying out or versus what they're receiving, but they're not in one single day writing a $2 trillion check. It's just a slow, easing out of $5 to $10 billion, $20, $30 billion. I don't know what the number is, but it's not 2 trillion a day. It's or 2 trillion at one time. It just adds up day after day after day after day.
What I can do next week is show you by going into the Fed balance sheet that the Treasury, there is an item on the Fed balance sheet which suggests that the Treasury is giving the Fed money. They're giving them actual dollars, and it's on the balance sheet of the Federal Reserve. It's on their income statement. It's below the net income line, but it's there and it's clear. All right, so that the Treasury is not just not getting this profit; they are paying money to the Federal Reserve because the Federal Reserve is losing money in its day-to-day operations because its assets are not yielding enough to cover the cost of its liabilities. Now, the Fed is also not printing money to cover that loss. There's no indication that the Fed is printing money to cover that loss because if you take a look at the assets of the Federal Reserve, they're shrinking. They're not rising. They're down by $940 billion. So, number one, the Fed is got to go to the Treasury for money. Number two, the Fed is not printing money to cover their losses. So number three, while there is no statute that says they can't do this or that, the other thing, there is a marketplace, and the marketplace says you can't do this. You cannot go out and print money to cover your losses, particularly if those losses start to continue to accelerate in size because you've decided to increase money rates somewhere else. But the bottom line that is in the marketplace right now is why are long rates going up? And the long rates are going up because the money supply is going down. And I think that there's a very close correlation right there, which I think is demonstrable.
What Professor Furman didn't seem to underline, and it seems to me it is a loss, it's the inflationary impact. We all lose because of rising prices. Your number some time ago, Dick, on an episode, you said the money supply grew by some 26% year over year at its height. And just to give a sense of the startling numbers, and to pick up also on what Matt was talking about, the writer in The Hill said it is essential to understand that these are not mark-to-market paper losses. They are real cash losses resulting from the Fed's expenses being to this remarkable extent greater than all its revenue. Maybe he's taking a political stance, I don't know, but it's certainly interesting. The other issue then, I'm kind of with Matt in the sense that the Fed could keep growing its balance sheet, shrinking, but once we can print money writ large and we are the reserve currency, does any of this really matter until it does matter?
Well, I think it matters right now. I think that the Fed, is showing that it can't increase the size of its balance sheet. Now, you might argue they're showing that because they don't want inflation to increase because they'd be increasing the money supply. But the Federal Reserve is shrinking the balance sheet. The Federal Reserve has also made the decision not to print money, but rather to borrow money in the repo market because they understand that if they continue to print money, and they haven't done this for a while, but if they were to continue to print money, then there would be a big increase in inflation.
So is the net effect of this that the Fed could reverse all of this by lowering interest rates, and it's the question of when? Or is the net effect of this that eventually this gets out of their control?
No, you're right. If the Fed were to decrease interest rates, substantially, it would, number one, solve the problem of the banking industry, because now all of a sudden the cost of deposits would come down to a level that the banks could afford to pay because the assets that they have would be yielding enough money to pay for those deposits. Number two, the value of those assets would go up substantially. So all of a sudden, the banks would not have, if you will, negative net worth in some cases. And the same is true of the Fed. If they reduce interest rates sharply, then, basically they're not going to be paying the amount of money to the banks that they're paying the banks now for their deposits. They're not going to be paying, the repo market, the money for their deposits, for the money that they borrowed from in the repo market. All of those costs come down dramatically, and the yield on their assets pretty much stays exactly where it was, because, these are all fixed income securities that they own on their balance sheet. So they go from a loss to a profit. Ultimately, they are going to do this, and ultimately that is going to happen. The step from here to there is just not going to be easy. In my estimation, it's going to be a recession, which is going to be painful.
Going back to my prior question, is that the goal? And the goal is to have a recession to reduce inflation?
I think it is. That's my.
Is there a better way?
My view is that there is a better way. My view is that the government, for the last, number of decades, and this gets to this fight in Congress. I mean, I don't agree with the way that the congressmen are attempting to overthrow what have you and refuse to, compromise. But I agree with what they're saying. They're saying you just can't keep borrowing money to cover deficits that you're not earning, and it's got to stop. And I think that, what we saw, with inflation getting to 9% in June of last year was the result of just continuing to borrow money to cover over whatever problem there is. In other words, the governments don't control the financial system. The financial system is controlled by, in a capitalist economy, by money flows profits, not profits, what have you. That's what controls the demand for money, the supply of money. Ultimately, the government can't do that. And every country that's tried to do it from the United States on down has found out that, there is a tremendous cost. Cost is inflation. And if inflation gets out of control, it's the cost of the whole financial system.
Dick, the Fed's favorite inflation gauge rose less than expected in August. The personal consumption expenditure index, excluding food and energy, grew a tad 0.1% for the month of August, lower than many had anticipated. And on a 12-month basis, core PCE was 3.9%. What's going on? What do you make of this? Because I'm looking at the Wall Street Journal today, has an interesting headline which speaks to what we're going to talk about now. Americans just keep on spending. Consumers are spending and spending. You know about the Taylor Swift phenomena. Ticket sales are through the roof. They're going on vacations. They're indulging, I guess. It's this post-COVID spending mentality. We'll see how long it lasts.
Let me do the thing that you probably get annoyed with most. Let me refer to my family. I have a granddaughter, and my granddaughter, just graduated from college and is now a teacher, right?
Well, congratulations.
But she took all the money that she earned this past summer before she got her teaching job, and she spent it to buy a ticket to London and an $800 ticket to see Taylor Swift. All right. So she took every dime that she had and she spent it on this trip to London and, lodging, air flight, etc., and, a ticket to see Taylor Swift. All right. And she's not the only one in my family. A niece did exactly the same thing. So the question is, she can't do that anymore. She's tapped out. Right. And that's the American population. What we've seen over the last year and a half is that the spending patterns of the American population went from fixing up their houses to what they now like to call experience expenditures. Experience expenditures would be, tourism. It would be eating out at a restaurant. It would be paying for an entertainment, etc. But now what we're seeing, and this was admitted by, Brian Moynihan, and it was admitted by Jamie Dimon, the heads of, the two biggest banks in the United States, and it was admitted by Jane Fraser, the head of Citigroup. And that is that we're now starting to see loan losses creep up from the lower income portion of the household population. And we're starting to see a shift in spending patterns away from these experience expenditures to basic needs. The cost of, food, the cost of gas, the cost of, the things that are repairs, the things that are necessary. So I don't think the consumer is going to spend like crazy. I think, and the borrowing trends are showing that they're borrowing less money. I think it's clear that the consumer is now getting tapped out. And I think that what's doing it is higher interest rates, higher costs, higher everything. And I think that's why the Fed needs to clear up the situation by clearing it out with a recession. I don't know how much money these auto workers are going to get. I don't know how much money they deserve. I do know that if they get what they're asking for, that's going to reduce employment. It's going to send jobs overseas. And I think that, that can't be allowed.
I feel there's a sort of an existential crisis at play here as well. And the price of homes, I think to some degree play into this. There's just a lot of young people who want to start a family, buy a home, just simply are locked out. You cited some of the numbers in a note here, Dick. If I could just go through some of them, they're fantastical, as they say. Existing home prices rose in most of the 177 metro areas in the second quarter. The average price increase was 9%. Mortgage rates are up to 7.51% in the third quarter. Monthly mortgage costs are at record levels in 159 of the 177 metro areas. These are all your numbers. Median monthly costs are now $2,500. That's up $750 from a year ago. No wonder people are buying Taylor Swift tickets. if you can't buy a house, you have to spend it somewhere.
Yeah, I'm sorry. I see these numbers, and it to me it's divorced from reality because 62% of Americans are homeowners. That means 38% are renters. But of those 62%, 95% of them have been in their houses over a year, which means they have mortgage rates dramatically lower than what you're citing. It's not like the median price just hit that number. The median of the new purchasers is that number. And that's a small percentage of the homeowners out there. And so I feel like it's a lot of doom speak to try to make it sound worse than it is.
Well, two things. While you gentlemen were just speaking, I went to the Federal Reserve website and I typed in the Federal Reserve quarterly reports, and I got that to pop up here. And I took a look at the income statement of the Federal Reserve in the second quarter this year, and there is an item there which says earnings remittances to the Treasury net negative $30 billion. Which means that the Treasury paid $30 billion to the Federal Reserve to cover their losses in the second quarter of 2023. And again, you can find that by going to the Federal Reserve website and looking under quarterly. So
I believed you, Dick.
I was not sure that I was giving you correct information, and therefore I wanted to look it up.
Is that part of the national deficit? Is like that an official number, or is that one of those ones where it's like an accounting line item that gets netted out because they think in the future the Fed will pay it back?
It's a cash outlay, so it's got to be part of the deficit.
Sometimes we don't trust the government. I'm just curious.
No, but Fannie and Freddie and the Federal Reserve are the two. Ginnie Mae also, that have to pay every quarter the dividend to the Treasury, and they can't. In the case of these two companies, they can do it, but in the case of the Federal Reserve, they can't do it. That's very negative. But the point I'm trying to make in the housing stuff is that there is a shift in the housing market, which is requiring more new houses to be built. In other words, the cost of existing houses, according to the National Association of Realtors, has reached a level where in order to get a mortgage, you've got to put up 20% in cash, and you got to have roughly, if paying 7.5%, and based upon the current cost of houses, you got to be making $99,000 a year. All right. And certainly it's probably over 100,000 since they came out with their numbers. And the point, therefore, is that the existing housing market is not going to provide the housing needed to house what is this growing population of people between the ages of 25 and 44. And that's got to come from the new housing market. And the new housing market now is providing 38% of the sales of houses that are occurring in the country. So the net of it is that I think a housing boom is likely. And the way I like to think about it, Fannie and Freddie have got to be released from their conservatorships because they've got to fund it. And they can't fund it as part of the conservatorship. So I'm trying to make a couple of points here, one of which is new housing is got to be used to meet the needs of the, if you will, growing population of young people. The new housing has got to be funded by money coming through Fannie and Freddie. Fannie and Freddie can't do it unless they're released from their conservatorship. So there's going to be pressure on the government to release those two companies.
I think you nailed it in the first point, though, which is they receive profits from Fannie and Freddie, and releasing them is deficit increasing. And the perception is that it rewards Wall Street. At least that's the generic Main Street view, is that anything that benefits is taking that money away from the Treasury is benefiting Wall Street. And so it seems like it's unpalatable, as much as I agree with 100% with what you're saying.
Yeah, no, you're right. I mean, you're obviously right. The whole reason that these two companies have been in conservatorship for 15 years is solely due to what you said. There's too much money that these companies are giving the government, roughly $25 billion a year now, that the government is going to be willing to give up that money in order to, facilitate the growth in housing. So the question that it comes down to, and it's always come down exactly in the fashion that you just indicated, we're keeping them because we're keeping this money. But it could be that if a housing crisis reaches a level where it's becoming important for the economy, that the federal government is going to have to give. It's going to have to give way in some shape or form. It may say, okay, we'll release you from your conservatorship, but we're going to charge you, 2% of every mortgage which is made, for the guarantee that we give, through Fannie and Freddie. But I mean, there's got to be some denouement in which we get the money we need to facilitate the building of new housing, to facilitate putting these people into these houses, at the same time not ripping the U.S. government off of the profits that they're taking now because of their socialistic move to buy, to control the housing industry. So, I mean, I think there's a lot of issues, wrapped up there. But I mean, you're definitely right. They're not willing to give up Fannie and Freddie because they're not willing to give up the profits that they generate.
You have a number here, Dick. New homes now account for 38% of total home sales. So to your point, a housing boom may be ahead. The other thing that plays into this is high rents. Rents have risen at an extraordinary rate in some of the metro areas. I know New York, New Jersey, really high, and sure in other parts of the country. And we hear of couples in New York City just paying this phenomenal sums to rent, but it's actually in many cases much cheaper than buying a home. So they're not buying homes, and they're spending the money then on Taylor Swift tickets.
That's true, but they're also, as I mentioned, Taylor Swift's next concert after the one in London is not going to be as well attended because basically the homeowner has to pay, not the homeowner, the household has to pay more for gas, has to pay more, is paying more for food, is paying more for, if they choose, entertainment, and they can't, and their incomes are not growing as fast as the requirements on those incomes. And therefore, I think that leads to tough times.
Speaking of energy and fuel, an interesting setup there, Dick, because you've been reading The Rare Metals War by, can't pronounce his name. I guess he's a French writer. He wrote it in 2018. And I've sort of two things we should bring up here. They keep talking about core inflation and then they exclude energy and food. I don't know whether that's a new concept, but it doesn't look like energy prices are coming down. So question is, will we bring down fuel prices? There's this whole debate, and it's the Green New Deal and folks getting upset about fossil fuels. You read this interesting piece on the rare metals war, and it says that producing an electric car requires more energy than producing a conventional car.
Yeah, this book was a shocker to me. It was written by a Frenchman named Guillaume Pitron. I guess, I don't know, I couldn't pronounce it right either. But the point is that it's called The Rare Metals War, and it was written actually in 2018. And this guy, just blew my mind. And I really strongly recommend people read this book, or if he's updated it in some fashion, because what he's saying is, first off, if you take a look, first off, he shows you how many rare metals go into an electric car. Then he shows you how many go into a lithium battery. Then he shows you, how much, an iPhone takes in terms of rare metals, right? Okay, so now he's demonstrated the fact that we need these rare metals in this modern economy. But then he starts saying, okay, but to get these rare metals, which by the way are not that rare, you have to mine hundreds of thousands of tons, literally hundreds of thousands of tons of, conventional metals, and separate the rare metals from the conventional metals. And he's saying that the ecological, the environmental impact of mining all of these hundreds of thousands of tons of metals is something that countries in the West simply won't accept. In addition to which, when you've extracted the rare metals, you are putting radioactive, things into the water supply, so that you're polluting the water supply. And as a result of that, and he uses France as his example, because obviously it's French, it's a book written in France. He uses the examples of how they were forced to shut down the mining of these various rare metal facilities because, number one, the cost was too high to clean up, the pollution that they create. And number two, the Chinese were willing to do it for nothing, basically speaking. And then he goes on to show, he's claiming that 1.8 million Chinese have died as a result of the pollution that, was created in taking that out. But then he goes to the next step, which is, okay, so you put a lithium battery in the car. How much carbon dioxide does the lithium battery excrete? And it turns out that if it's a car that can go, we'll say 300 miles on a battery charge, right? It excretes as much as, conventional fossil fuels, so that you're not saving anything. And then he goes to windmills, and he talks about how much windmills are polluting the air with because of the rare metals that they use and the carbon dioxide that they exude. And then he's making the case. And again, he may work for an oil company, as far as I know. I'm not validating what he's saying. I'm just saying what he's saying is, if you add up the cost of taking the stuff out of the ground, the cost of putting it into the car, the cost of what it does when it's in the car, or the iPhone, or the solar panel, or he's saying that solar panels, if we continue to grow them at the rate that we were growing them back in 2018, they would create as much pollution in the air as 600,000 cars do. All right, and he's going step by step. All right, so now he's saying everybody in the West won't produce these rare metals because of the cost of doing so. China is willing to do it. So the next step he goes to is, okay, now China is controlling the rare metals. All right. This gets even more complex, but let me try to say it simply. In the United States, in the last 20 or 30 years, the business concept was developed that we will create the innovative product, and we will have someone else manufacturing. And they don't have the capability to match us in terms of creating these products, and therefore we're safe in doing that. Well, what he's saying is that now by 2018, and it's obviously 2023 right now, he's saying they have caught up. They have caught up in China in terms of not only do they control the metals, but now they can match you in terms of the technological advances, and they're using this as a weapon. And he's giving examples of what happened in Japan. I'm telling you, this is a terrific book. He's giving examples of what they did to Japan, so that they forced Japan to cave and move all of its purchases to China at China's prices, not at the prices that China charges internal companies, but the prices that China charges Japan, and that has impacted the Japanese economy. So, the book just blew my mind.
Do you recommend it?
Yeah, strongly recommend.
Well, we don't, of course, we do not know if he's a paid shell for the energy industry, but if his facts are correct, right. Facts are facts.
I have some comments on this. One, there is not yet a green energy that, aside from hydro, which has a different environmental issues, and nuclear, which also has its own negative issues that some people allege. There's not a green energy out there that is net positive in energy, and the subsidies of the governments out there right now is they're trying to get the industry up to a point where it is net positive for the environment. But as of today, you go through any of the types of green energy, the amount of steel and coking coal required to build those giant windmill blades and then ship them from China over to America, and then on diesel boats through the Panama Canal, up the East Coast, and then put out to sea, and then you have a bunch of tugboats using diesel to go out and manufacture them or to install them. You look at all the windmills across Texas and across Iowa and across basically everywhere in the United States where there are those giant windmills. Almost all of them come with 900 gallons of diesel that's in the base to run the motor that keeps them turning when the wind is low, because if they don't keep turning, then it can lock up. And so a lot of these are actual net, not a lot of them, all of them are net negative energy creators, as a way to try to goose the industry to get to a point where that's no longer the case. But I thought it was well known. I don't think that's a disputed fact at all, that green alternatives are net carbon producers overall, because of how much it takes of carbon to create the manufactured product. And the idea is that eventually that's not supposed to be true, but it doesn't seem like we're getting anywhere closer to that. The other thing I would point out is countries that have really, really, push the needle to the end, like Sweden and Norway, where 60 or 70% of their car sales are electronic cars, they've not at all reduced their oil consumption. Even as they've transitioned, what they've done is shifted where the oil is consumed within their country, and it's not been a net positive. It's just flattened the curve, so to speak. So I don't think anything that Dick is saying is controversial. I don't think that this guy's a shill. I think it's just math. I mean, this is just physics. When you're talking about MMBTU conversion, you have to count all the conversions from digging the coking coal out of the ground, putting on a ship, shipping it to China, digging out the contents of steel, putting it into a coking factory and melting the steel, or talking about the silicon, similar for making the silicon for the solar panels. It requires an immense amount of coking coal and an immense amount of diesel to get those solar panels created. So I don't think that's a controversial statement at all. It's just, I think it's kind of hidden by the industry because of the agenda of trying to push green energy as the alternative to fossil fuels in the future.
I mean, it's just incredibly important because we are, providing government subsidies because we believe that as a nation, if we can switch over to this so-called green nation away from this energy-driven nation, we're somehow protecting the environment. And we're not. We are not. All we're doing is we're shifting control of the system away from the Middle East, which is the fossil fuel producers, to China, which is the rare metal, producer. But we're not benefiting by doing what we're doing at all. We are benefiting China. We are benefiting, there are other countries that have certain metals that he indicates. I
also want to comment on Rishi Sunak, the Prime Minister of England, the United Kingdom, revised their net zero targets. I think it was 2035 because it was unreachable. But in the speech where he revised the targets to, push them out further, he mentioned how, the United Kingdom was at 1960s level of emissions, and that was, a great success because getting back to where they're a much smaller economy and they were a much smaller population of emissions, it is something to be appraised. And one of the things he mentioned, though, was that their reductions were the equivalent of about 6 months of China's increase, that their net difference to the world was negligible, if not infinitesimal, because China and India are growing so rapidly. And the other thing that I think was just a commentary around that speech where someone mentioned that China is at basically 1/5 per capita the amount of emissions as the Western world, and India is at 1/15 the amount of emissions as the Western world. And these are growing economies who are not going to be prioritizing expensive energies at the expense of their economies. And as they keep growing their economies, their emissions are going to grow, and it's going to dwarf any amount of supposed net savings the Western world gets by shifting. So what we're really doing as a world is shifting the pollution away from the Western world to the growing developing world, and we're subsidizing that by subsidizing these industries that wouldn't be competitive if they had to stand on their own 2 feet.
I did read a report, Matt, just picking you up on that. The UK is looking more favorably now on drilling and exploring. And,
well, they have to.
Yeah,
I mean, they were committing mass suicide by one, leaving the EU, and two, trying to become energy independent by focusing on green stuff. While, by the way, they're in one of the cloudiest parts of the world, and the winds sometimes in their wind farms areas are so strong they have to turn the windmills off because it's a blessing of abundance.
There's a lot of rain over in that part of the world, as I know. But you're not, neither of you, I'm certainly not, you're not against EVs, electronic vehicles. It's a wonderful thing if we can get to that level and do it cheaply, right?
This isn't a political conversation. I think we're talking about physics. It's not what you want. It's that physically the goals are not physically possible.
Also, it doesn't come up enough, it seems to me. Dick, you've talked about inflation, so has Matt. If we had opened up the pipeline and, hadn't shut down the pipeline, we wouldn't have had a lot of this raging inflation we have in America today, correct? Remember we shut down the pipeline when Biden came into office? So my point being is that, there has to be some sensible, I don't want to use the word compromises, but sensible economic approaches to keeping inflation down. That could mean drilling, fracking, and opening up the pipeline.
Yes. In other words, that's the point. I think the thing that I think is the desirable approach to go is to make use of the fossil fuels, but try to figure out how you can cut the problem of the carbon dioxide emissions, right? If you can control the carbon dioxide emissions, there's no reason to go to these electronic vehicles, because it's shocking, because the electronic vehicles are not saving you anything in terms of energy. In terms of pollution, if what this guy writes is correct. And I assume it is correct, because he's citing all sorts of, government sources of information, sources of information coming from universities. So why should we switch from fossil fuels, which we can control, to these energy efficient, so to speak, technologies if they're not energy efficient? There's no reason to do it. And so Matt laid it out clearly, but I was not aware of the fact that there was no, if you will, pollution control savings by doing what we're doing. Is just a major cost to it and a shift of who we're going to let control the game. The other thing that, is pointed out in this book is they don't care in China how many people get radiated when they pull this stuff from the ground, because they intend to control and they do control the market for these metals around the world. I mean, if he's right that 1.8 million people died of radiation poisoning in the areas that he's pointing to, and that China just doesn't care, then, not only are we being hoodwinked into believing that we're saving, the planet at a time that we're killing people to save the planet, and I don't get it.
Yeah, I think along those lines, there's been a funny article that's been going around talking about how this new Panasonic plant, where they're building batteries, I believe it's in Kansas, is requiring a massive coal factory, power plant nearby, which was scheduled to be shut, to be replaced by windmills. Now they're extending the life of it because the battery plant for the electric cars, requires the power from the coal plant. And, when you start going backwards from the electric cars, and, when you asked, or am I against electric cars? I mean, not at all. Of course I want electric cars. I don't like walking down the street and having exhaust thrown in my face. But when you're doing it from a perspective of, oh, we're saving the planet, but when you realize what you're actually doing is extending coal plants and increasing demand for coal plants in China, because that's one of the things that they've been actively building along with nuclear plants, is because it's a cheap source of power. And if that's what they do to create the electric batteries for us, that's all well and good for us that live in the cities and we'll have cleaner air. But if you're doing it with this overall goal that somehow you're reducing pollution to the planet, it should be a wake-up call that that's probably not what's happening.
And the other thing that I think we tend to shut down debate by those who oppose the Green New Deal. A lot of reputable scientists have been shut down when they've produced their own competing evidence, and that's simply wrong. They've been cancelled. That's not right. The name of the book is The Rare Metals War by Guillaume, I guess, Pitron. My French was never that great. It was published in France in 2018. A few other takeaways, Dick, that you quote here. One solar panel generates 70 kilograms of carbon dioxide, and smartphones are dirty phones. And what else does he say here? They will generate it. He estimates if solar panels increase their power generation per year, they will generate as much carbon dioxide as 600,000 cars.
Yeah, it's
unbelievable.
Because these lithium batteries also emit carbon dioxide pollution. And if we keep making bigger and bigger lithium batteries to drive these electronic cars, they're going to be creating more pollution with carbon dioxide than gas-fired or fossil fuel-fired automobiles. Now, again, that's his statement, not mine. I'm not a scientist. I don't know if it's correct. He may work for an oil company. I don't know if that's true or not. But, he claims that this is backed up by true science.
Coming back to the banks, which you cover obviously extensively, any interesting individual stories? I know you've been looking at Citigroup, Truist, and Capital One.
Yeah, no, I think that each one of those banks has a point to make to the economy. I mean, right now, the hatred of bank stocks is so strong that in the past 5 years, I'm sorry, in the past 5 years, bank stocks have gone down in 4 of each of those 5 years. And if you take a look at the 106 biggest banks in the United States, there are only 4 that have done better than the S&P 500 over the last 5-year period. So the marketplace sees and understands that there's a serious problem in the banking industry in the United States. And I think it came to an extreme point, and we do have a strong buy recommendation out on this stock, just for full disclosure. We don't have any relationship with Citigroup, but we are recommending the purchase of this stock. But anyway, it's come to the point where the market is overdoing its stress on these companies. Citigroup right now has a market capitalization of something like $78 billion. It has over $200 billion in cash. This company's market capitalization is only 25% of the cash that it has, in quotes, in the bank. So, I think that becomes an extreme valuation because, if Citigroup were to be liquidated, the liquidation would result in some $120 billion being handed out to the, holders of Citigroup stock. Now, Citigroup can't be liquidated because it's, it's a company controlled by the government. But the fact of the matter is, if it wasn't controlled by the government, you would have all of these corporate raiders, all over this company, trying to figure out a way to break it up, to extract the value, which is sitting there right now on the balance sheet. And I think that, again, we're not recommending bank stocks in general, but I am recommending Citigroup. But the fact of the matter is, and you can get that report from contacting your Odeon Capital Group salesperson. But the point that I'm making is that you go to extreme levels in valuation, on the upside and on the downside. And I think at least in the case of a company which is selling at 25% of its cash, it's selling less than half of its book value, but 25% of its cash. It's an overreaction by the market.
And overall take on the banks, are they stabilizing? Because you've spoken about a crisis and stresses on the banks and them shrinking. Where is that now?
That's continuing because, the United States government has a problem. The problem is that the President of the United States said that we're going to guarantee every deposit dollar in every bank in the United States, which cannot be done. There's $19 trillion in deposits, $11 trillion are insured, and there's only $160 billion in the insurance fund. And, again, I don't believe that the FDIC can go to the Federal Reserve and say, print $2 trillion to bail out the banks. I don't think Congress would be willing to pass a bill, as they did in the savings and loan industry, which cost, I think, something on the order of $500 billion to resolve the S&L problem. I don't think those things can happen. So if the government has this obligation, how does it get out of this obligation? It's got to shrink the banks. It has to create rules which make it difficult for the banks to lend money, and it's got to force them with capital requirements to shrink so that the risk to the taxpayer is not great. So I think we're dealing with what started with the Dodd-Frank Act, but in 2010. But I think what we're dealing with is a recognition on the part of the government that the financial system driven by private banks, which are guaranteed by the government, is not going to work. It's got to be more of a capitalist system, and I think that they're forcing the industry in that direction.
Isn't the solution what it always is? I mean, we talk about can't they just lower interest rates and fix all these problems? I'm baffled because it seems to me that the higher interest rates are now becoming a feedback loop that are creating higher interest rates. And I just don't understand why they're keeping interest rates this high this long when it's causing all these problems in the economy. And it feels like, looking at the latest PCE number, that they're basically winning on inflation. And if inflation was really derived not from monetary policy, but it was derived from shutdowns in the economy due to COVID, then shouldn't they declare victory and just fix this?
Well, you're absolutely correct that lower interest rates would fix it, would solve the problem that we're now dealing with. The issue is, why don't they do it? And they don't do it because they believe that the steps necessary to get interest rates lower will increase inflation, which will have a bigger impact on the economy. Whether it will or not, I don't know. But at least that's why they're doing what they're doing. But you are definitely correct. If interest rates were cut in half right here, the vast majority of these problems would just disappear.
I think I heard Professor Jeremy Siegel saying yesterday that we won't have an interest rate rise in November. That was his prediction.
Yeah, well, I listened to what he said yesterday, and he doesn't understand money either. I mean,
these professors really don't know much. They're in their ivory tower.
Well, I mean, he didn't talk about money whatsoever in terms of why interest rates are where they are. He said they are where they are because the economy is getting stronger, and I don't believe the economy is getting stronger. Number one, but number two, that's not why they are where they are. They are there because the money supply is shrinking.
Dick and Matt, we're out of time. A great conversation. We'll come back next week to the economy, inflation, energy, the banks, and a lot more. And until then, until episode 90, take care.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.